What you are about to listen to is a presentation on emerging real estate markets. If you take action and decide to become involved in emerging real estate markets, you will discover a very little-known avenue for creating a windfall of cash flow and profits that will get you to your financial goals faster and easier than you knew possible. Hi, my name is David Lindahl, and I've been investing in emerging real estate markets for over 14 years. At this recording, I own over 7,000 units across the United States in 12 different emerging markets. I wrote the #1 best-selling book, and it continues to be a bestseller, Emerging Real Estate Markets. For this presentation, I've got 3 different objectives. The first is to explain what an emerging real estate market is. The second is to have you discover the advantages of emerging real estate markets. And the third objective is to show you how you can take the next step and start investing in emerging real estate markets yourself. So, what is an emerging market? Well, an emerging real estate market is a market that has the potential to appreciate very quickly over the next 3 to 5 year period. And it doesn't matter what the national economy in the United States is doing at any given time, because throughout the United States there are several markets that are emerging. They're micro markets that, although the economy may be doing very well or the economy may be doing very poorly in the United States as a whole, there are markets that are appreciating very rapidly. And I have focused on these markets over the last 14 years, and I have created a substantial amount of wealth for myself and my family. And I have students all across the United States that are doing the same thing as well. And myself and my students have many, many different investors who have, after listening to this presentation, have decided to invest themselves in emerging real estate markets. So let me give you an example of an emerging market. Back in the 1990s, in Phoenix, Arizona, Sun Microsystems created a headquarters and also a campus facility that created over 20,000 new jobs in the marketplace over a 3-year period. That market appreciated over 42% over that 3-year period and continued to appreciate into the 2000s. In Dallas, Texas, between the years 2005 and 2008, the Metroplex being Dallas, Fort Worth, and Arlington, attracted over 120,000 new jobs into the area. The market appreciated over 46% within that time frame, and it continues to appreciate today. The holy grail of emerging real estate markets is job growth. And what I have done, and what my successful students have done, have followed job growth throughout the United States. Job growth is the only thing that will take a market that has been downtrodden or has been slow and put it into the recovery phase. So our focus is to discover where the jobs are going, why they're going there, and more importantly, follow the migration of people into those job growth areas. And because we do that, we prosper. So let's talk about market cycles, what they are and what the strategies are investing in there, and also what determines which particular phase of a market we're in. Now, at any given time, any market or any city, any town in the United States, and Canada, North America, and other countries throughout the world are going to be in one of the 4 phases of a market cycle. They'll be in what's called a seller's market phase 1, a seller's market phase 2, a buyer's market phase 1, and a buyer's market phase 2. And if you think about it, there's 2 versions of what you're listening to. One is a DVD and one is a CD. So at times you may catch me referring to the screen. But for those of you that are listening on audio only, what I'm showing is a graph that looks very similar to a roller coaster. And picture in your mind a roller coaster going up the hill and then down the hill and then up the hill and then down the hill again. And on that graph, I want you to plot some points. A quarter of the way down the hill, I want you to put in BM1, that stands for Buyer's Market 1. Going all the way down to the bottom of the hill, the trough, put in BM2 II for Buyer's Market 2, or BM2. Going up from the trough and going upward about a quarter of the way, or a third of the way, let's do a third of the way, put SM1, that stands for Seller's Market 1. and then go 3/4 of the way up and put a SM2. That stands for a seller's market 2. Now this is the typical cycle. This is the path that all markets take. The good thing about this path is that we know that these phases, the 4 phases of a market cycle, always follow each other in this particular order. And because of that, we can be prepared to change our strategies as the cycle changes or as the phase changes. One of the key mistakes that real estate investors make is that their market cycle is changing and they're unaware of it, and because of that they don't change their strategy, and eventually they get caught holding the bag, so to say. They buy a property that they really shouldn't have bought, and they're holding it for a time period where they really should have sold it a while ago. The whole idea between market cycles and market phases is the fact that these phases are changing about a year before the media recognizes it. So what you want to be doing is changing your strategy about a year before the newspapers and the media are reporting the changes. You may remember a time when the media was saying, buy real estate, buy real estate, buy real estate. You know, they talked about how much money people made in real estate. And all of a sudden, 6 months later, real estate crashed. And a lot of people got caught holding the bag. And that was because the market had actually started changing about a year prior to that, and anyone that knew about market cycles and market phases had already been selling off their properties and did not get caught holding the bag. There are times when the media is saying, don't buy real estate, times are tough, stay on the sidelines. And typically that is the best time to be buying because the market had already started changing and it had already started creating momentum. And we're going to talk about that momentum. So just so you know, the average time that it takes a market to cycle is anywhere between 8 to 12 years. The average time between these phases is anywhere from 3 to 5 years. So let's walk through these phases. And I'm going to give you the key characteristics of these phases and the key strategies that you should be using at any given time. And by listening to the CD or watching the DVD, you can actually take this newfound knowledge on market cycles and use this in your own backyard, because you should always be investing in your own backyard. And then when the information I'm going to be giving you on emerging markets, you can go back to the person who gave you the CD or DVD and ask them how you can get involved in investing in emerging markets. So let's start with a seller's market phase 1. And for those of you not listening to the audio, that is a quarter of the way up the roller coaster. And on a seller's market phase 1, the key characteristics are supply on the marketplace starts to dwindle, because this is the backside actually of the emerging market. Supply starts to dwindle because people are scooping up properties fast, especially speculators. Properties are selling very quickly in this particular market phase, and you've got a lot of speculators in this particular market. We ourselves are considered very conservative investors. The only properties we buy are properties that cash flow properly. We're not speculators. Eventually, you can make a lot of money speculating, but we'd rather be very conservative in our investing, knowing that we're always going to be safe with our cash flow. If something happened in a marketplace where it changed very quickly, unforeseen, then we'd be safe because we have our properties cash flowing properly. Whereas speculators buy based on potential future value increasing rapidly, and then they plan on selling out and obtaining all of the appreciation in terms of cash. Well, problem with that is if the market changes very quickly and you can't sell your property, then you have a property that is actually depreciating in the sense that it's losing value. And a lot of people in the late 2000s, 2007, 2008, got stuck holding the bag on properties that they speculated on, couldn't sell the property, and are now upside down on those properties, meaning they can't resell them for what they paid for them. So as a conservative investor, we're always looking for our properties to cash flow properly, so that does not happen to us. Also, some key characteristics on a seller's market phase 1 is that the time in the market is actually at its lowest point, the time that it takes a property to become under contract. At one point in this particular phase, you'll actually see bidding wars for properties. And who remembers when there was a time when you heard about a property going on the marketplace for, let's say, $500,000, and it gets bid up to $550,000 to $600,000, because that's just the phase it's in. So, because of the demand, in reality, there's a lot more investors in this particular market phase. Some other characteristics of this phase are unemployment is low, property prices and rents are rising, and the key characteristic of all is that demand is at its highest point. So because demand is at its highest point, we can do the two strategies of real estate investing, which are either buy and hold and flip. This is the only stage where we can do both buy and hold and flip. And the reason being is because demand is so great in this market. We can buy and hold and realize a whole bunch of appreciation, or we can realize that appreciation and flip the property and buy an even bigger property. And this is called trading up. And one of our strategies is to trade up to the biggest property possible, because when we're holding the biggest property possible, when our market appreciates, that property's value is worth a lot more. So if the market appreciates by 10%, say in a 6-month period, well, 10% of a $2 million property, 10% appreciation would be $200,000. 10% appreciation of a $200,000 property would be $20,000. Same amount of effort, just a lot more of appreciation. So that's why we're always looking to get into the next biggest property. So let's go into a seller's market phase 1. Now we're going to transition into probably the riskiest of all market phases. The seller's market phase 1 is 3/4 of the way up that roller coaster, and it ends about a quarter on the other side. And that's what makes it so risky, because this market is actually going to peak out, and it's going to roll over, and it's going to go down. Because of that, the only safe investment in this particular market is to be flipping your properties. The strategy in this market is to flip, either hold on to your cash and wait for your market to correct, stagnate and correct, because cash is king in a down market, or take that money and move it into an emerging market and watch it explode again and again and again. So a seller's market phase 2, there's still upside potential in this marketplace. But you need to recognize when you're in this particular phase and get out of it. You need to sell all of your assets and get into a cash position. And you know what? You may sell out while the news media is hyping up how great real estate is. And you may sell out and watch the market rise for another year and a half, and you may see another 10 or 15 or 20% of value come into the market. But don't fret, because if you try to wait and time this market and hit the peak and miss it, even by a month, you're actually going to end up holding onto your property for a good 3, 6, 9, 12, 15, 18, and all the way up to 2 years. I was talking about months. So 6, 9, 12 months, 18 months, 36 months. Because at the peak of the market, everybody now realizes is that it's the peak, and more properties come on the marketplace. So the market becomes oversupplied. And it's harder to sell your properties when the market is oversupplied. And not only that, on the backside of this seller's market phase 2, you're actually losing value, because rents will start to decline as well. And when rents decline, that means cash flow declines, and that means value declines. So let's take a look at some of the key characteristics of a seller's market phase 2. They are: the time in the market that the properties are staying on the market starts to increase slowly at first, and this is actually our first indication that we're in a seller's market phase 2, and this is our buy signal, our sell signal. Time begins to increase slowly at first, and then it really starts to increase rapidly. Supply on the market increases. As it takes longer and longer to sell property, more and more starts to come on, so there's more supply on the marketplace. Not only that, we're seeing the end of the construction boom. Actually, it hasn't ended yet. It won't end until the market actually starts to crash. But because we're in the second half of an upcycle, the supply of properties coming onto the marketplace is huge at this particular point. So banks have continued to lend new construction even though they know that the market's starting to become oversupplied. There are less and less buyers in the marketplace. Sellers are waiting, but they're still getting their inflated prices on the front side of a seller's market phase 2. But on the back side of the seller's market phase 2, they're not getting those inflated prices anymore. The construction pipeline is excessive, and most importantly, business and job growth begin to slow. While job growth is the enabler of all emerging markets, it is also the death of emerging markets as well. So when jobs start to slow and business growth starts to slow, then it's time to pull out of the market. It's time to get into a cash position. You can still be flipping in this particular market, especially if it's in your own backyard. But if you're looking around your area in North America for another emerging market, or another market to be investing in, you do not invest in markets that are in this particular phase. You only invest in your own backyard in the seller's market phase 2. So that's going to bring us into a buyer's market phase 1. And in a buyer's market phase 1, as you can see, this is a quarter of the way down the back side of the roller coaster. This is when you have your arms in your air and you're screaming. And you should be, because the property values are taking a free fall at this particular time. The key characteristics of this particular phase is that the market continues to be oversupplied because there are not a lot of buyers in the marketplace absorbing the oversupply. Investors are on the sidelines and they're waiting because they know prices and rents are falling. And they want to wait until the market's near bottom. Now, they don't wait until the exact bottom, but they wait until they can see the bottom in the distance. And when they can see the bottom in the distance, then they'll start buying again. But until then, prices and rents will continue to fall. The time on the market will continue to increase as well until we can see a bottom in the area. And I'll talk about exactly where that bottom comes from. New construction becomes stagnant because there's nobody buying these properties. There's actually, with job loss, there becomes an outmigration of people out of the marketplace. So, and because unemployment reaches its height, and because foreclosures start to rise sharply, people are literally walking away from their properties. And they're moving to where jobs are. They're moving to start a better life. So there's no new construction, and there's a lot of empty properties that need to be rehabbed or repaired on the marketplace. In a buyer's market phase 1, the prices of investment properties fall to the lowest level of all 4 phases. Now, there is only one thing that is going to change a market's momentum from going down to going back up again. And it's not going to immediately go back up. But that one thing is job growth. And job growth happens right about 3/4 of the way down your roller coaster. If you're watching the DVD, it's right where the arrow is pointed. So it's 3/4 of the way down. And there are 3 different phases of an emerging market. There are job announcements, job construction, and job fulfillment. The job announcement happens right here. It says that an area, there's announcements going on. Like, for instance, when Phoenix announced that Sun Microsystems was going to build a plant there, well, that was the first indication of activity in the marketplace. And the local investors that had been through market cycles previously, that had the experience with market cycles, they started buying again. So the market started creating momentum, but it wasn't enough momentum to shift the market around to go up the other side. That happens during the construction phase. Because typically what happens in the construction phase is you'll have a lot of construction workers migrating in order to build the infrastructure for the different companies that are coming down to go into the marketplace. And Sun Microsystems, they didn't create 20,000 jobs in Sun Microsystems. What happened was they brought 8,000 to 10,000 new jobs in, and then the multiplier effect took hold. There were a lot of ancillary services or ancillary businesses that grew around Sun Microsystems. A lot of their suppliers followed them there, and because their suppliers followed them there was job growth. Not only that, for all of the people that now moved into the city, new service jobs were created. The butcher, the baker, the candlestick maker, to take care of the new population growth that was coming into the city. So for every new job going into an emerging market, there's what's called the multiplier effect. And that means that 2 or 3 additional jobs are going to be created in the service sector to take care of the needs of the new job that's been created. So therefore, with the multiplier effect in those service jobs, those are typically the people that are going to be renting our apartments as well. So as the new construction happens, the first wave of people coming in are actually the construction workers. Now, they don't plan on staying for a long period of time. They're going to rent apartments, and they're going to absorb the oversupply in the apartment sector. And the apartment sector is going to be the first sector to move in an emerging market. And then we'll go into the fulfillment phase. And in the fulfillment phase of the emerging market, this is when the construction is done, and then the new jobs are fulfilled with the new employees And this is when the market really starts to take off because these are the permanent workers. And yet the apartment sector continues to rise. It rises faster than the single-family sector. It rises along with the office space and retail sector. They go hand in hand. But single-family houses don't rise yet. There's a lag time because the new people that are coming into the area, well, they're not sure where they want to live yet. They're not sure if the job's going to last. So they're going to wait about a year or so because they're going to typically sign a year's lease. They're going to wait a year before they go house hunting. So therefore, the apartment sector, the commercial sectors, rises about a year before the single-family house sector rises. So your strategy in the buyer's market phase 1 is to hold for cash flow because literally there is no appreciation in this market. Although job announcement is going to be a fortune teller per se of what's to come and could be a leading indicator. It actually is a leading indicator of appreciation that is just around the corner, but it has yet to happen. There's still a little bit of a bottoming out to go. So let's go into the buyer's market phase 2. And in the buyer's market phase 2, this is what we call the millionaire maker. This is the start of the emerging market. This is when you're in a market like this, you want to be buying with both hands. You want to be backing up the pickup truck and filling it up to the brim. Because in a very short period of time, you're going to see appreciation take off like a rocket ship. And this is because the jobs have just started to come into the market. The construction jobs and then the fulfillment jobs are now into the marketplace. The oversupply is being absorbed. Key characteristic is the time when the market starts to decrease, job growth increases, the holy grail has come into the marketplace, existing properties are being rehabbed, rents begin to slowly increase, and prices begin to slowly increase. The key characteristic of this particular phase of the marketplace is that rents begin to slowly increase. And they begin to slowly increase because absorption has come in the form of migration, people migrating to get those new jobs. They're absorbing the oversupply of apartment units on the marketplace. And because they're absorbing that oversupply, they're creating new cash flows in the apartments. When cash flow goes up, net operating income goes up and values go up. So we start seeing prices begin to rise in our apartment buildings. And it's a beautiful thing. So the buyer's market phase 2 is the phase that all of us investors look to make a windfall of profits. Now, if we go back to the graph and we look at the buyer's market phase 2, which is at the very bottom of the trough, there's going to be two different types of investors, and each investor is going to be on either side of the trough. You're going to have contrarian investors and you're going to have momentum investors. Contrarian investors are going to start investing while there's job growth, during the job announcements in the area, because they know, depending upon the strengths of the jobs that are coming in, who's coming in and why, they know that that's a good indication of where the market's going. And then you have what's called momentum investors. Momentum investors actually wait for the construction jobs to be fulfilled, for the ground to be broken, for the permits to be released. And then they start buying as they see those rents start to increase. Either one of them are good. You can be both a contrarian investor and a momentum investor. I know I'm both. I know a lot of my students are both. It all depends on which particular market you happen to be interested in investing in at which particular time. So let's go forward and talk about some good indications of what a good emerging market is, or some characteristics we look for in emerging markets. Well, one of the characteristics that we like to see is a college town or a university town, because there's always an influx of new students, and those students are always looking for new housing. And not only that, good colleges also produce students that create businesses in the area as well. So we see business really congregate and cluster around a city that has a good solid college foundation. We like state capitals. When you have the combination of good colleges and state capitals, you've got a market that typically will rise, stagnate, not really participate in the downside of market cycles, although they have the potential to, but they don't go down as far. But they certainly rise up fastest and farthest. So we like to see state capitals, and we like to be in state capitals. That doesn't mean that we only invest in state capitals. As a matter of fact, Let me give you Texas as an example. I'm invested in Austin, Texas, and I've got a 200-unit apartment complex there. But I'm also invested in Beaumont and Brownsville and a lot of the secondary markets in the Texas area. And the reason being is because Texas markets tend to become oversupplied very quickly. Once the major markets start an upturn, because there's so much land there, they build. And oversupply and lack of job growth are the two key factors in a market that, in the decline of any particular market. But in the secondary markets, typically supply cannot be generated on the marketplace because rents don't rise high enough and fast enough to support the new supply. So usually there's a big lag time in the secondary markets in an emerging market as to when the supply is coming on the market, so you can make more money longer. So that's why we like secondary markets as well, especially in the Texas markets. If we're up in the northeast or the southwest, or the northwest, I should say, those markets are very compact, and especially the ones that are on the coast, because when you're on the coast, if you're on the east coast, you can't build anything to the right because you fall into the ocean. If you're on the west coast, you can't build anything to the left because you'll go into the ocean. That's called a barrier to entry. And we like barriers to entry as well. Those typically make for good markets. When we're going into a market, we like to see new big box retail being generated. Big box retail being super Sam's Clubs, for Walmart, those super Sam's Clubs. We like to see super Walmarts. We like to see super Targets. We just like to see Home Depots going in, Lowe's, big box retails going in, because they've done their demographics as well, and they see what's happening in the marketplace, and that just confirms what we're seeing also. We like it when our particular area is a healthcare hub, when people drive from miles around to go to this particular area to be serviced for their health needs. This typically makes for a good market. Every emerging market needs to have strong leadership. I'm from Brockton, Massachusetts. The city of Brockton was down between the late 60s all the way up into the early 90s. And the reason it was down is because it had, well, first of all, a lot of the jobs had gone overseas, and we know that story. Brockton was the shoe city capital of the world at one particular time, or the United States at least, where they built most of the shoes that people used. But then there were cheaper labor overseas. Most of the factories moved overseas, and because of that, there was a lot of empty properties, and there was lack of job growth, and it became a very blue-collar, tough city because drug dealers and pimps and prostitutes moved into all those empty properties. And Brockton had difficult times for a number of years, and it never had strong leadership. And as a matter of fact, it had leadership that was indicted because of things that they didn't do properly. Until a gentleman by the name of Jack Unitz, a new mayor of Brockton, came in, and he took over that city, created strong leadership, created infrastructure, got the roads repaid, had 5 new schools built, and attracted jobs and job growth. And I just happened to be started investing when Jack Unitz came into leadership there. It's before I knew about emerging markets, but I certainly recognized the difference between bad leadership and good leadership in a marketplace. And I recognize the fact that all emerging markets need good leadership. Let me give you an example of difficult leadership, and that's the city of Pittsburgh. The city of Pittsburgh lost approximately half of its population, from 700,000 down to 300,000, because its city government is so fractured that they can't get anything done. So there's no centralized, strong leadership. They can build great sports stadiums, but it's very difficult for them to implement the changes that they need to attract jobs into an area. Although we're starting to see some changes in Pittsburgh. And then we also like to see major interstates going through a particular marketplace, because interstates facilitate the transportation of goods and services. So we at least want to see one major interstate going through, or north, south, east, west, and if we got one going north, south, and east, west, that's great. And if the city tends to be is a transportation hub, that's even better. Another characteristic we like to see in a marketplace is an airport. We want to see at least one airport. It could be a small regional airport, but we want to see at least one major carrier there. All right. Now, airports aren't a necessity of an emerging market, but we like to see it when we can, because it will help to fuel the growth faster, and you'll see higher appreciation in a market even a small market that has a regional airport. Small markets being any population over 100,000. We like markets 100,000 plus, or within the general vicinity of the city, 100,000 plus. Anything less than that, then it's going to be very difficult to resell our properties when it becomes time to resell, because most national or institutional investors, they want to see a population of 100,000 plus, or they're not going to buy. So what does that leave us? That will leave us, if we buy in a city with a population of 40 or 50,000, with only the local investors to be our investors. And when that's the case, it's going to take us longer to sell our properties, and we may not see as much reward. We also like to see our city to be a shopping hub. A shopping hub is, where the regional shoppings are, where the major mall is. We like it when people drive from miles around to come into the particular area, because then we know that other retail is going to be built there, and there's going to be a transaction of dollars, and there's going to be good tax benefits in that particular city as well. So shopping hubs are important to us as well. So based on everything that I've just shared with you, you might be thinking to yourself, why should I be investing in emerging markets? Well, we just went over the different characteristics of the emerging markets, and we talked about the fact that emerging markets have great appreciation in a very short period of time. And actually, when you're in the right market at the right time, and that's the type of investing that we like to do, you are going to see higher than average returns on your money invested. And isn't that what it's all about? Getting higher returns on our money secured by real estate so that we can become wealthier faster, so we can reach our financial goals easier and quicker. That's why we like emerging markets. And what I just explained to you is how an actual area develops and becomes an emerging market, and what the key characteristics are for you to get that higher appreciation. Initially, in an emerging market, when you're in early, there's not as much competition. You may be from a market that's very competitive, and you have a lot of different investors out there, and they're buying and selling on a regular basis. But remember, in an emerging market, we're on the backside of the market. All of the weak investors have been shaken out during the buyer's market phase 1 stage. All of the local investors. There are no national investors or institutional investors in this particular market, because it's been going down for the last 3 to 5 years. And then all of a sudden it starts to take a change. And when it does, yes, some of the local old-timers are coming back in. All the newer investors that got shooken out, they're not coming back in. No, they've already gone on to something else in their life. Eventually, we'll see newer investors in there. But you'll get in early, and you'll get in before the national guys get in there. And that's when the pickings are, they call it the low-hanging fruit. This is when you get some of your best deals, and you'll make your most amount of money. You can trade up faster into bigger properties, because you're going to buy a property. Let me give you an example. I bought a property, a 30-unit in Huntsville, Alabama, with my sister. It was 30 units. We bought it for $400,000. At the time, Huntsville was just beginning to be an emerging market. There weren't a lot of national investors in there. And this was the first of several properties that we bought in the marketplace. Well, within a year, that property had appreciated, and we sold it for over $800,000. We doubled our money in 1 year's time. We traded up to a 71-unit property, and within a year and a half, that property had appreciated to over just a little over $1 million in value. We're in the process of selling off that property, and we're going to move that one up into a property that is approximately 200 units. So when we say trade up faster, then we're trading up faster. The first property, the 30 units, cost us $400,000. The second property cost us $1.6 million. The third property will cost us about $3 million. But here's the beauty. We took no money out of our pocket using 1031 exchanges. And 1031 exchanges can be explained at another time. If you're not familiar with them, you may Google them or ask the person that gave you the CD or DVD what 1031 exchanges are, but they'll help you become wealthier faster. So a $3 million property appreciating at 20% would be about $600,000. Now my $400,000 property, I may have said $600,000 earlier, it was $400,000. So the $400,000 property appreciating at 20% is $80,000. So that's the difference between trading up to a bigger property faster. So you can actually be rewarded with the appreciation faster. And when you take no money out of your own pocket, what gets better than that? That's the power of investing in emerging markets with 1031 exchanges. And then Why emerging markets invest like the institutions invest? You know, the real estate investment trusts, they don't just only invest in the city that they created the trust in. No, they look around and they look for the highest returns, and then they invest in the cities with the highest returns. And isn't that what you should be doing with your money? You know, when you decide to buy a stock in the stock market, you don't buy a stock with a company that's in your own backyard where it has its headquarters. No, you look for the stock that's going to give you the biggest return, or you look for the mutual fund that's going to give you the biggest return. Should you consider doing the same thing with real estate? Absolutely. Go to the areas that are going to be appreciating the fastest, and you will become wealthier faster, or you will increase your holdings a lot faster. Your bank account will grow faster as well. So how do we take the next step? Well, taking the next step will be very easy. Well, what you need to do is contact the person that gave you this CD or DVD, and they will ask you to fill out a form. It's called the Accredited Investors Form. You simply fill out the form and hand it back to them, and they can tell you about the properties that they have available, or the different types of properties that they're investing in. When done properly, emerging markets will explode your wealth. And I want to congratulate you for taking the time to listen to the CD, and I want to congratulate you for taking the next step, and I'll see you at the top.